Hi there, this is Simon, a certified financial coach. Most people don't realize how taxes can significantly impact the net after-tax returns. It's clear that picking profitable investments is vital to growing your wealth. However, investing for tax efficiency is equally important since it lets you keep more of your gains without sharing them with the federal and state governments. So in this video, I'm highlighting a number of strategies to minimize your taxes related to your investment portfolio. Each of these suggested investment strategies can be individualized depending on how you choose to align your investment diversity, risk tolerance, and time horizon. Number one strategy is to target long-term capital gains. Investing in assets has a favorable tax treatment for long-term capital gains. This includes investments in stocks, ETFs, mutual funds, bonds, and real estate. If you sell an asset after holding it for longer than 1 year, its gain enjoys preferential tax rate of 0, 15, or 20% depending on your income level. Long-term capital brackets are very generous. A single individual or a married couple filing jointly can have well over $500,000 in gains and be at only 15% tax bracket on these gains. In comparison, if you hold an asset for less than 1 year, its gain will be taxed at a higher ordinary income level. A single individual or a married couple filing jointly and having $500,000 of taxable income would be at 35% tax bracket. If your ordinary tax rate is in at 22% or higher, you're better off being in 15 or 20% capital gain tax rate, unless your ordinary taxable income is at 10 or 12%, which is not very common for most people on W-2 income. This is why long-term capital gains are so much more preferential over short-term gains. It allows you to keep more of your gain money to yourself. Number two strategy is to write off losses. If you sell investments at a loss, you can write off and deduct up to $3,000 of net losses from your other taxable income. If your capital loss exceeds $3,000, you can carry over the remaining loss to future tax years. This is called carryover of capital losses. Number three strategy is to carry over capital losses. If in any of the previous years you had investment losses of more than $3,000 that you could not use to offset against gains, the loss gets aggregated as capital loss carryover on Schedule D. For example, if your aggregated capital loss carryover is $20,000, you can sell equities with $20,000 in gain and avoid taxes on the gain. Number four strategy is to harvest tax losses. Tax loss harvesting is simply offsetting gains with losses. In other words, it is a timely selling of equities at a loss to offset the amount of capital gains taxed owed from selling profitable assets. There is no limit on the amount of tax loss harvesting. One thing to keep in mind, in order to avoid worst sale rule that prevents claiming a loss, you need to wait for 30 days before repurchasing a substantially identical investment. Number five strategy is to invest in companies with qualified dividends. Some equities, including stocks, ETFs, and mutual funds, pay dividends. Dividends come in two classes, qualified and ordinary. Qualified dividends are taxed as capital gains at tax rates of 0, 15, or 20% depending on your income level. Ordinary dividends are taxed at a higher ordinary income level. A dividend is considered to be qualified if you have held an equity for more than 60 days in the 121-day period that began 60 days before the ex-dividend date. It is an ordinary dividend if you hold it for less than that amount of time. Some dividends may not be considered qualified dividends. These include dividends paid by real estate investment trusts, known as REITs, and master limited partnerships, known as MLPs, and business development companies, known as BDCs, and foreign companies. Most regular dividends from United States corporations are considered qualified. So if you stay with qualified U.S. company stocks, You need only to hold onto the shares long enough to qualify for the dividend payments. Number 6 strategy is to reinvest dividends. Reinvesting dividends contributes to capital gain subtraction that can save your tax money. It's not a tax deduction strategy per se, but it's one that many taxpayers miss. If you have stock dividends automatically reinvested in extra shares, each reinvestment increases your tax basis in the equity. That in turn reduces the amount of taxable capital gain when you sell the equity. Number 7 strategy is to invest in U.S. treasuries. When investing for fixed income, interest income from the United States treasuries is exempt from state income taxes and are only taxable at the federal level. If you live in one of the high tax states, this can amount to a significant amount of tax savings. As a side note, interest from certificates of deposit known as CDs or interest on cash that you hold in a regular or high-yield account are subject to both federal and state ordinary taxes. Number 8 strategy is to invest in municipal bonds. Interest income earned on municipal bond is exempt from federal income taxes. When you buy a municipal bond issued by the state where you file state taxes, the interest you earn is usually also exempt from state income taxes. If you buy municipal bonds issued by another state, you'll still avoid federal taxes, but you'll likely be subject to state income taxes. Number 9 strategy is to trade in retirement account. If you are actively and frequently buying and selling securities in the stock market, you should preferably do that in retirement accounts such as IRA or Roth to avoid any tax consequences. Profits in these accounts are not taxed until funds are withdrawn. Number 10 strategy is to buy and hold in taxable brokerage account. Since gain in taxable brokerage account is subject to capital gain taxes, it's suggested to maintain positions in investments for an extended period of time in regular taxable accounts to minimize any tax consequences. For example, if you trade in a regular account and pay 15% in capital gain on profit, you will need your next investment to gain 17.6% to even up to the amount that you owned before taking the profit. If you pay 30% ordinary federal and state tax, you would need your next investment to gain 42.8% to even up to the amount you owned before taking the profit. This might take some time and some effort to achieve. Number 11 strategy is to obtain a real estate professional status known as REPS. The term real estate professional status is a designation recognized by IRS, and it relates to the taxation of income generated from real estate activities. You do not need to be a real estate agent to obtain the status. To qualify, an individual must meet certain criteria outlined by the IRS. Although the designation requires qualification, once qualified, it can provide a substantial tax advantage. Achieving real estate professional status allows taxpayers to treat real estate investment activities as non-passive, potentially enabling the offset of rental real estate losses against other forms of income, such as wages or business income. The main criteria for qualifying requires that an individual spends more than 50% of the working time in real property business or rental activities and is materially participating in these activities. This topic might be a bit complex and requires deeper dive, and if you're interested in more details about REPS, drop a comment and I will do a separate video on this topic. In summary, we covered 11 strategies to minimize taxes on investments. But ultimately, your investment strategy depends on your choices and should align with your financial goals, risk tolerance, and time horizon. If you found this video useful, please like it and subscribe to the channel to get updates on future videos. Thank you for watching.